All right, let's jump straight into this explainer and decode the massive paradox hanging over Synopsys right now. As you likely know, Synopsys provides the absolutely critical electronic design automation, or EDA, software that makes advanced chips even possible. But lately, their story has totally fractured. We've got a massive acquisition on one hand, a huge AI-driven technological shift on the other, and honestly, a very confused retail market caught in the middle. So today, we're unpacking the data to figure out if Synopsys is a strong long-term hold or if these current growth concerns are genuinely justified.
And the split in sentiment right now is just wild. After their fiscal Q2 earnings dropped, the market decisively punished the stock, setting it down 8.6%. But then you look at the response from Wall Street analysts. They looked at the exact same data and aggressively bumped their price targets by an average of 7%, with the consensus implying some really strong upside. You rarely see this kind of immediate, real-time divergence between market sentiment and analyst modeling.
Which, of course, raises the ultimate question, why on earth is a company providing the essential software infrastructure for the AI revolution just flatlining, while the rest of the semiconductor sector has absolutely boomed? To understand this disconnect, we have to look way past the headline numbers and dig into the actual mechanics of their recent earnings and their strategic acquisitions.
Well, it really all comes down to how you slice their growth. On paper, Q2 revenue growth looked absolutely phenomenal, up 42% year over year, hitting $2.28 billion. But that massive number is heavily distorted by their $35 billion acquisition of Ansys. When you actually strip Ansys out of the equation, Synopsys' organic growth was really only hovering around 3 to 4%. And for a high-flying tech stock, that single-digit organic growth rate, yeah, that is exactly what spooks the retail investors.
The earnings picture gets even weirder when you look under the hood. Take a look at these financial paradoxes. Adjusted earnings per share actually fell by nearly 9%, yet their actual adjusted net income rose by 11%. So how does that happen? It all comes down to share dilution. Synopsys' share count jumped by about 23% year over year to fund the Ansys deal. Interestingly, that deal even included a direct $2 billion investment from NVIDIA. Basically, the pie got bigger, but the number of slices increased, which drove down that per-share value in the short term.
Okay, so why would Synopsys willingly dilute their own shares just to buy Ansys in the first place? 2 words, $500 million. Actually, scratch that, it's 3 words, but you get the point. According to industry data, the cost of designing just a single advanced 3-nanometer chip is skyrocketing past $500 million. The complexity is literally getting out of hand, requiring engineers to intricately balance power, performance, and thermal dynamics in 3D chip architectures.
By smashing together Synopsys' electronic design tools with Ansys' mechanical and thermal simulations, they're building a unified mega-platform to drastically cut those massive development costs. And the performance gains here are striking. Their new multiphysics fusion tech is showing up to 3 times faster design closure, plus 2 times faster turnaround for complex analog designs. On top of that, this expands Synopsys' reach far beyond just silicon, allowing for full chip-to-grid simulation in automotive, aerospace, and defense. This right here is the long-term value the analysts are modeling, even if the broader market is hyper-focused on the short-term integration noise.
So let's move into Section 1, tracking the smart money and institutional positioning.
Because while retail investors are sweating the Ansys integration, the smart money is absolutely pouncing. Vanguard and BlackRock, the passive giants, both bumped their already massive stakes by roughly 20%. But what's even more telling is that active hedge funds took huge leaps. Gotham Asset Management increased their position by an aggressive 620%, and Aspects Management bumped theirs by 135%, securing a nearly $750 million stake. These institutions are very clearly looking past the temporary dilution and betting heavily on the long-term structural advantage Synopsys is building.
Meanwhile, if we look internally, executives are making very modest, entirely expected stock sales. We're just seeing normal compensation timing and standard equity awards being processed. There's absolutely no mass exodus of shares from the C-suite. This really measured approach reinforces the idea that the internal outlook remains super stable and confident.
Let's pivot now to Section 2. The technology catalyst, specifically focusing on AI and agentic revenue. Moving from the balance sheet to the actual tech, we need to evaluate how these new design tools are actually going to impact future revenue. The entire semiconductor supply chain relies on Synopsys, and their software is rapidly evolving. We are shifting from a world where AI is just a basic co-pilot answering simple questions to fully autonomous systems where AI executes complex workflows on its own. This is the exact catalyst that will change how Synopsys gets paid. Enter agentic EDA. This is absolutely crucial. Instead of a human engineer clicking through endless menus, specialized AI agents autonomously perform the heavy lifting of verification and implementation tasks. And listen, this isn't some science fiction pitch modeled for 5 years from now. Synopsys already has 20 major customers actively evaluating over 25 specialized agents today.
And this evolution completely rewrites their long-term bull case. Historically, Synopsys made their money on step 1, traditional flat-rate subscriptions for human engineers. But as we move into step 3, agentic consumption, the whole model flips. Customers will keep their subscription base, sure, but they will also pay usage-based consumption fees depending on how much computational heavy lifting these AI agents are doing. Basically, the more a customer relies on these agents to speed up chip design, the more revenue Synopsys captures. It's a brilliant shift.
And management knows exactly what they have here. CEO Sasan Ghazi explicitly stated they are looking to capture more of this value, confirming on the latest earnings call that they expect to have a few signed customer agreements operating under this new, highly lucrative monetization model by the end of the current fiscal year. They know their software is indispensable, and they're finally adjusting their pricing power to match it.
So, as we look at the timeline ahead, the narrative is definitely shifting. We're moving past the recent May 2026 earnings drop and the cloudiness of the Ansys integration. By July, management expects to realize 50% of their committed Ansys cost synergies. But honestly, all eyes are firmly locked on September 2026. That highly anticipated Investor Day is where management promises to detail exactly how these new AI consumption models will work and, crucially, lay out their long-term margin expansion goals.
So here is the ultimate takeaway for you to chew on. The smart money is already placing their bets. They're totally ignoring the organic growth blip caused by the Ansys acquisition, and they're looking straight toward a future of AI-driven consumption revenue. The big question for you is, are you willing to look past the near-term integration noise to capitalize on a company that is quite literally rewriting the economics of AI chip design? That is exactly what you need to weigh before September rolls around. Thanks for joining me on this explainer, and keep learning.